Okay, very good morning everyone. So this is the briefing for the 4th of May 2018. We're just going to be going over your major asset classes today, having a look at the currency market, which has continued its sort of descent, your major FX pairs following this dollar strength story. Technically looking pretty interesting, having taken out some key levels, some lead indicators suggesting there may potentially be a reversal in order. We'll discuss that a little bit more in detail. Going to have a look at the equity market yesterday, which had quite a strong move to the downside, taking out once again another 200-day moving average technical level, extending its losses, only then to have quite a sharp reversal.
Chinese officials believe that U.S. trade delegation proposal.
And then whipping up back above the 200-day daily moving average, and then sort of consolidating with a slightly negative day. We're going to finally then look at the WTI crude market and gold market, to see how the recent geopolitical developments and trade talks and the Iran sanctions are having an impact on that market there. So I'd like to start off just quickly flicking through the FX market, and we can just have a look at coming in this morning. We've continued to see a little bit of dollar strength in this market, just following on the theme that we've been seeing now for about a week or so, just continuing to see this decline in the euro dollar. Quite a steady decline here at the moment, just going in. What it does seem to do is take out the previous lows, go in for a test, and then continuous decline. So having a look at this day here, we opened, so this would have been on Monday. Just as soon as we opened, we went one way really, selling all the way into the close, a little bit of a bounce in S2 and then continuing to sell. Another heavy down day, a bit of whipsaw price action here. However, yesterday there was a bit of consolidation here. This was relatively surprising to some extent, because the European inflation number, especially your core reading, came in at 0.7% compared to the 1% expected. So quite a big miss there on the European inflation. But given where euro was trading already quite weak against the dollar, that dollar strength really driving this market down, we saw a momentary blip lower around the 9:30, so around here. Didn't really manage to break any further, and then just consolidated with a little bit of dollar strength coming in at the end of the day, but otherwise that currency pair remaining flat. And I think given the fact that we had that miss on euro area inflation, and then the market didn't want to move any lower, I think was a good telltale sign that this market was just a little bit fatigued at the moment. Having looked at it on a slightly longer time frame, let's see where this market could be going. I wouldn't want to be looking to trade against this trend at the moment. There's definite negativity here, but we are just finding a bit of a breather around this 1.20 handle at the moment. And if we have a look at where we are technically, it's coming up to some key levels here. I think the next point which would give us some confirmation that there's further selling pressure coming in is just this region over here. Previous support, resistance has acted very nicely as sort of a springboard to take this market any higher. And looking at it in terms of buyers versus sellers, it was this price which really saw this extension higher from this previous bullish move. So now that we're approaching this level, I wouldn't be surprised to see a bit of consolidation, but a breach of these levels will then open up a bit of downside. So we've got the 1.19 handle below that. Another key level of support and resistance over here. And then going down, I think next medium-term level, if that level is breached, the next support region we have really is down here, and this is sort of the continued dollar strength while the euro area, the inflation is falling, and we know how Draghi is with inflation. He looks at it very, very closely and really does determine his driving decisions going forward. So it's going to be interesting to see what comments he makes on your core reading being so much lower. Similar story. I just wanted to have a look at one last thing here, which was your RSI. So even having a look at your RSI here, we're on your daily continuation, so a generous time frame, well below the 30 mark, which is considered to be oversold, and we have sort of continued to sell off. So technically the market may be looking well poised for a bit of a breather, if not a reversal here, if we're looking at good support resistance levels, as coupled with the fact that the RSI is in highly oversold territory. I just wanted to also just flick across to have a look at the euro area inflation on a slightly longer time frame. So yesterday, just focusing on that core inflation, I think the headline inflation is becoming less impactful given the fact that you're going to see positive beats there nowadays if core inflation is lower, given where the price of oil has been trading is 10% up on the year. So that's going to have a positive influence on your headline figure. So having a look at your core reading, it's one of the lowest inflation numbers we've seen sort of 2016. Last time we were below here was back in 2015. So 3 years on, euro area inflation is still subdued. I'm sure Draghi is going to be keeping a close eye on this, because that sharp downtick lower is something he's going to note and he's going to be a little bit worried about. And ultimately, I would believe that this stronger euro is having a negative impact on this. We've heard comments from companies such as AUDUSD come out and say that their earnings are lower given the strength of the dollar or the weakness of the euro as well. Looking at your FX, other FX markets, we have cable. Just looking at this market on a weekly chart, so a little bit more technically, just to see these key areas of resistance which have been taken out recently. So we were in a channel, albeit not the neatest channel I've ever seen, but you know, steadily rising sterling post these Brexit lows, inflationary fears taking over, and the market's been trending higher, and this recent leg higher on the back of this expectation that the Bank of England was going to hike rates. Market came under some pressure, and look, we've taken out this trend channel which has been in place since 2017, so that's 15 months trend channel which has now been breached. Now if we drop it down to a daily continuation chart, we can see that we did breach it, which is obviously technically significant, but then we came in to retest it. We then took out the previous lows. We found a doji after that, so the market was flat yesterday, just following on the story from the dollar as well. After this heavy buying, just a bit of consolidation, and we are now trading a bit lower. So quite a bearish market here at the moment. Just want to double check this moving average is correct. Yep, so this is now a 200-day moving average coming into play here in cable. So that's the next key area of support. My feeling on this, I think again with the euro, I want a little bit of consolidation. If we throw on the RSI here, this too is in heavily oversold territory, trading at 17 at the moment, or sorry, printing at 17 at the moment. So given we've taken this trend channel out, we've tested it, we've consolidated, we've got the 200-day moving average, and the RSI is overbought. I wouldn't be too aggressive with this market is my main takeaway. I'd be surprised if we breach this today. I'd expect some consolidation for the rest of today. The only thing obviously which will drive it is the employment numbers coming out later, which we'll discuss in a moment. But in the absence of anything major, I'd expect a consolidation, and then next week to see the first test of that, and then a continuation lower may be in play. Let me just quickly throw on the moving average, because we did break our moving average in the 200-day moving average in euro dollar. So we can see euro dollar managed to break it, retest it, providing some near-term resistance. So I think technically, looking at the correlations and technicals, I'd be surprised. I definitely wouldn't be looking to trade in these FX markets aggressively coming into this morning ahead of the wage numbers. Okay, let's have a quick flick through the Aussie dollar as well, steadily rising. Yesterday, what we were seeing is that this performing very well as a risk asset, was rallying quite nicely along with oil in the US equity market. Just seeing a bit of a downtick at the moment. Have a look at dollar yen. Again, this has been a tricky market to trade, really. Continued dollar strength while the equity market has remained quite subdued. So people buying the yen as the equity market just looks like it's facing some continued pressure, but then the dollar also taking a bid has made this market slightly less tradable, at least fundamentally. Technically, we did have some comments come out of the Bank of Japan. Just looking at the correlations has been quite difficult, but looking at some comments coming out of the Bank of Japan, we did see sort of a rally as the yen weakened, but it's quite difficult to call this market. I'll be interested to see if we see positive comments come out of the US and China trade discussions. Positive comments coming out of China and the US and China's trade discussions, I think, would be very, very interesting to then trade the dollar yen, because we'd see the dollar strengthen as well as equities rally. So the dollar strengthening and equities rally means the yen would sell off, and I think that would be an opportunity which I'd be looking for to really enter this market. So we have that twofold effect of both currencies in the pair moving in the same direction. Key support level been tested yesterday. Let me just draw this up a little bit better. I'm on 20. So an area of previous support here where buyers really were stepping into the market. 1.09 providing some resistance on the upside, but keeping an eye on this level here. Below that we got the S1. Doesn't look too good for the entry, but the S2 level more in line with these sort of double bottoms. This region here would be something where I'd be expecting sort of a continuation of this uptrend. Just being careful with these FX pairs at the moment, but keeping a close eye on the equity market, which we will be turning to just next. So having a look just quickly, European markets at the moment, DAX in a bit of a consolidation phase, just hasn't really moved anywhere. The FTSE 100 continuing to gain here slightly, just benefiting from just ticking back above its pivot level, probably benefiting from this weaker pound inverse correlation which has been coming into play very nicely recently. Just wanted to have a look at the S&P. Oh, sorry. Before we go to the US equities, let's look at European equities. This break happened, I believe, on Monday, but it was a level we were watching quite closely. Was this 50% fib retracement from the all-time highs to the recent lows. And what we were seeing was this 50% fib working really, really well. 1 test, 2 tests, 3 tests, 4 tests. 4 to 5 tests, and the market really didn't move. And this market eventually broke on Tuesday after we saw a positive US session. So this was something you could have anticipated coming, because we had a positive US session on the Monday. And it was May Day, so European markets were closed. So as the European market had to play catch up, there was a technical level of significance. We were trading very close to it coming into Tuesday, and the European market needed to play catch up, and we saw quite an aggressive move to the upside, coupled with obviously some euro weakness as well, coming to test some key levels of resistance. So technically very good for the exit. Bring it down to a smaller time frame, however, this 50% fib level sort of came into play. I wouldn't really call that a test just yet, but again, I've got my eyes on this level to see if we can get a test. You could probably get a good risk-reward trade in here with quite a tight stop loss, technically well poised for some points of exit. Okay, next just turn our attention to the US equity market, which, if you guys were in the market yesterday, was quite a dramatic move. Starting off with a daily continuation. Let's clear all the technicals. Adding your moving average. This 200-day moving average has been coming into play on numerous occasions and providing support. And once again yesterday, so the February inflation fears test, second test, destabilization over here, and then yesterday we got a test here, and it looked quite heavy coming into this. If we look at how the prices responded, we fell, we bounced, but then the most recent bounces have been so much smaller. The pressure was really building to the downside here. I, for one, was definitely under the opinion that this move would be a little bit more dramatic. And it was to start off with, but we just didn't manage to hold on to the losses. Actually managing to print a positive day yesterday, but this pressure in this US equity market really hasn't seemed to subside. We broke here, the next day we rallied quite aggressively, second day rallied quite aggressively. Having a look here, yes, we did breach this 200-day moving average, just managing to finish above it, with the equity market still under some pressure here. It's a difficult one. It's a difficult one, this US equity market. I think it's all going to be down to if we're going to see a continued break of this, we're going to have to see a re-emergence of trade war risk. So this is a breakdown in communications between China and the US. And even this morning, just before I was jumping on the mic, there was a comment. Can't remember who the comment was, but it was the United States saying that China would need to cut their trade deficit with the US by $200 billion by 2020. Considering that May will be finished in a couple of weeks, we are almost halfway through 2018. That's a year and a half to cut the trade by $200 billion. And even though China has previously said they're not going to entertain such commentary, so hasn't gone off on the right foot, but we kind of expect this sort of aggressive commentary coming out of Donald Trump, so he'll probably bring this up to even a higher amount before settling at something rather reasonable behind quiet doors. So hasn't gone off, hasn't started off on the best foot just yet. Market doesn't seem too concerned at the moment. I'd want to see either a deal or no deal or a real breakdown of communications before I make a call. Otherwise, if we see the inflationary pressures building up, then again a move below here could be expected. If we look at where we found support yesterday, I'm not expecting anyone to have called this if you were short, but these lows here from Donald Trump's elections being 1 point, and this sort of low we saw in the last 200-day test, this was sort of level where the market bounced from. So technically it was there. I was short this market. I was looking more for an exit around these lows down here. Didn't really materialize, but technically this level did work well, and I'd want to see a breach this 200-day moving average and extension lower. So all eyes on the US jobs number. Also wanted to talk about the Dow Jones as well, which sort of triggered this recent sell-off, or at least was the catalyst for this move lower in the S&P 500, because this also for the first time in many years took out, not many years, sorry, since April, taking out its 200-day moving average. The outperformer has been the NASDAQ, which is still well above its 200-day moving average over here. So highly correlated markets. The technology sector has been outperforming, obviously, and at the moment it hasn't really gone to test its 200-day moving average. And the last time, well, the last real test was late 2016. Before that, we were below it in July 2016. So I think what a good tell will be is if this NASDAQ, this technology sector underperforms, and we see the Dow Jones, the S&P and the NASDAQ move below its 200 days moving average, where we'll start to see maybe another correction, so maybe another 10% fall in the equity market. I think there are some things which could trigger it, but those risks are starting to subside at the moment, so something to be aware of. More intraday, however, so keep an eye on this 26.15 level, dropping down to 60-minute, getting our pivots on. We are at the moment just largely range bound. So we've got some key resistance over here, sort of double top. This level in the S&P has been working very well repeatedly. So it's the low from the 28th through to early May, providing key resistance points. So any test these levels, obviously, we have seen selling pressure really build around these levels, previous support levels. So this would be if the equity market does rally with the absence of any fundamental drivers, and we get above R1, that'll be a good place to sort of sell. Otherwise, you still got this trend line for some support, and we got some lows to take into consideration around here. But all eyes will be on the average hourly earnings number later on this evening, so I'd be looking to play this market quite defensively. If I had to give it a direction before these numbers, I'd still be looking to get this market on the short side. So we do have some near-term resistance. Yesterday's highs, well, double top really lining up at the moment, so maybe range-bound markets coming into the US session. Next, I'm going to quickly turn towards oil. Just going to touch upon this briefly. WTI basically does not concern itself with US output production anymore. I think that is fair to say. We continue to see US output production ramp higher and higher and higher. So this is looking at your US field production in WTI crude. So let me just zoom in a little bit. Let's see just how aggressive this increase in US production has been quite recently. Quite a sharp increase here. So from 9.6 million barrels to 10.6, so 1 million barrels extra per per week coming out of the United States from December 2017 to April. So 1 million barrels of supply being added just from the United States alone. And WTI crude has done nothing but rally. And this is, again, number of things happening here. We're seeing OPEC and non-OPEC still sound pretty assertive that they're going to want to continue to curb their supply. We're seeing the tensions build in the Middle East. So we had the Syrian crisis, which is now subsided, but now I think the more focus is on Iran and the United States, where the 12th of May, Donald Trump's going to have to decide whether he wants to continue these sanctions on Iran or not. I would say that the market is quite correctly pricing in that he's going to continue these sanctions, which could result in a fall of 800,000 barrels a day over the course of the next few months, as partners who want to trade with the United States and get involved with their financial services sector need to show that they have cut their trade with Iran. So that will obviously have a material negative impact on Iran, but will also reduce the amount of supply of oil in the market. The reason I think this is going to happen is, well, Donald Trump, I think he's one of his main talking points coming into the campaign was that the Iran nuclear deal was the worst mistake in ever in history, etc., etc. And he has stuck by his word in his own unique ways. So I wouldn't be surprised if he wanted to sanction Iran further. Plus, we've seen Benjamin Netanyahu so the Israeli Prime Minister, also come out and say that he has evidence saying that Iran has not been abiding by these sanctions, continue with their nuclear program. So you may see this continued pressure from West and Israel build, and Iran face some sanctions. And this will result in oil trending higher. But having a look at where we've been since 2018 has started, really from January we started to bounce. Putting on our currency tool, we are higher by almost 20% here, from its lows to its highs. So 20% swing in 2018. So it has been a bullish move for sure. Just consolidating around the 67 mark here. Looking at a longer time frame, we'll need to go back to a weekly chart. The $70 mark, we're still looking for a first actual test here. Quite a uncomfortable area coming into play, however, with so next, natural support resistance lines. We do have some double bottoms here, but I'd feel like when we start coming to this 673 mark or this 75 mark, do we get those really strong points where I'd be looking to take sort of reversal strategies in this market. But an uncomfortable area coming up for sure until we reach there. So again, I'd be careful with oil. If we do get above this 70, it's not going to be a clean run. It's going to be very choppy till we get to the 75 mark, but still favoring the upside. That wouldn't be expecting any continuation extension start trades. I'd definitely be looking more for sort of a pullback. And looking at the price action quite recently for the past couple of weeks, it has been rather predictable. We've been selling off, and then we get to around the lows, and then we have quite a steep bounce, and then it takes us a few more days to come down. And then once we get down to bottom of this range, again, really aggressive candles to the upside, driving us to the top of the range. So the moves up have been very aggressive, and sometimes the moves lower have been slightly subdued. I've been feeling that the moves lower have been driven by dollar strength than anything else. So when you start to see some sort of rebate in the dollar, we normally see oil rally. And yesterday was no different. I know some of my guys were looking to get long this S1 level. Technically, it was a good setup. Didn't manage to materialize. The bottom of this range looking quite ugly, to be fair. Very hard to call. So again, with oil, you want to be rather defensive. But once again, I'd say if we start to come into sort of these levels here, you may see some support coming into the market. Below there, you got a double bottom here. So looking to go long the lows, stop behind there. And this is the unfortunate part when you don't have a clearly defined range. Even the pivots not lining up with any of these technical levels too well. Would also be looking... apologies, guys. Just realized I hadn't transitioned my chart across. So having a look at this oil market, this is the range I was talking about. Coming under some pressure and then bouncing. these levels down here where we've seen sellers step away and buyers drive the market higher, really coming into play, worked very well yesterday. So this region is going to be something to take into consideration. This coupled with the 67 mark. If we get a break of those, we do have a double bottom here as well, a pseudo double bottom, looking to go long the higher peak with using a stop just above. On the upside, we can see there is a slight downwards bias here. We are making lower highs, not the cleanest, but lower highs are being made, lower lows are being made. I think just looking at the macroeconomic backdrop, preferring the long, but technically I would be a little bit cautious. There is pressure building to the downside. Okay, so that wraps up sort of your major markets. I want to just have a quick look at the calendar and then I'll leave you to your trading sessions. So in terms of our calendar, we have a lot of PMI numbers coming out, largely final readings or from economies we're not too concerned about. So France generally can have an impact on the market, but this is a final reading for your PMIs, so not going to be market impactful. Again, with Germany, I'd keep an eye on it. German PMIs can move the market, but we've had such good European German data that I think even if we do get a beat, no surprises. Plus, it's a final, and even if we do have one negative week, doesn't change the overall picture. We do then have the overall European area market services final reading for April. De-risk, make sure your stops at scratch for this, but again, I don't think there's going to be a huge amount of market impact by these numbers, just given that they're the final readings and the regional numbers have already come out from Germany and France, etc., etc. That's going to take us into the main event for the day. We have non-farm payrolls today, so we're going to get the unemployment rate, which is expected to fall further to 4%. At one point or another, this unemployment level is going to lead to inflation. It has to. Economic theory cannot be disproved again and again and again. Every single month we continue to track lower and we're not seeing these inflationary pressures build up. There have been some comments regarding this. But average earnings month on month, we're expecting a small downtick. Previously 0.3%, coming in at 0.2%. However, that's looking at it more seasonally, month to month, year on year. The number is expected to stay flat at 2.7%. So it's 4% number from the United States. We are seeing businesses in the United States struggle to acquire the talent that they need, and this is sort of understandable in very low unemployment economies. If everyone has a job, well, then nobody's searching for a job, and if they're not searching for it, then it's difficult to recruit the talent that you need. So we are seeing that some of the smaller businesses, particularly in America, are struggling to find the skill sets and the staff to fill positions. That is important because sooner or later they're going to need the staff, and how are they going to attract that staff? By paying them more money, and that more money being paid to them will therefore lead to inflation. So your lead indicator will be average hourly earnings. So once again, keep your eyes on this number. I'm sure we'll be doing a rundown coming into this number around 1 o'clock, just looking at various components once again. In terms of speakers, we do have a number of speakers. Today we have ECB Constancio, who's a dove, speaking from central banks in historical perspective, what changed after financial crisis. Sounds interesting. Keep an ear out for that. ECB Weizmann, Fed's Dudley, who's a voter, speaking at 5 o'clock. So during our European session, we really have ECB Constancio speaking to be mindful of. Plus, given the fact that we had this lower inflation print yesterday, 0.7% versus 1% expected, I'm going to be quite interested. It's actually come and gone, so sorry, apologies for that. Come and gone. There's been nothing on the headlines for that. Next up, 2 o'clock, ECB Weizmann speaking as well, so quite a hawk there, speaking at the Bundesbank. So 2 o'clock, ECB member speaking. Alright guys, that wraps up your briefing for today. Any questions, please do let me know. Thank you very much and best of luck in your trading sessions.